Okay, so after you have analyzed all of the current assets, except for cash, and you'll know if it doesn't list, if you're not looking at a classified balance sheet, as soon as you get to an asset that isn't current, like land, building, equipment, okay, as soon as you hit one of those, then you know you've gotten all of your current assets. So then you move on to your current liabilities. And so where our adjustment was the opposite for current assets and current liabilities, for current assets, right? If it was a decrease to a current asset, the adjustment was to add. If it was an increase to current asset, the adjustment was the opposite and we subtracted. When it comes to current liabilities, the adjustment will go in the same direction. So if we increase a current liability, our adjustment will be to add. A decrease to a current liability, our adjustment is to subtract. And let's talk about why that is. So let's think about it. What makes accounts payable go down? Right? Accounts payable goes down when we are paying on our account. So that means cash is also decreasing. That's why we will subtract that decrease in accounts payable. An increase in accounts payable means that expenses are increasing, right? But we owe for them. So we have not paid. And so if we look at our income statement, we have amounts included in here in operating expenses that made net income lower, right? But it did not result in a payment of cash because we owe for it. That's why accounts payable is increasing. So since that increase in accounts payable was a result of expenses increasing that caused net income to decrease, but cash did not decrease, so we are going to add that increase in accounts payable. An increase to income tax payable indicates that income taxes were increasing, so they were deducted on the income statement, but cash, we have not paid the cash for it, we owe for it. So it made net income lower, but cash did not become lower, so we add that increase. A decrease to income tax payable shows that we paid our taxes, so that means cash decreased. So that's why we will subtract the decrease in income tax payable. So we can follow that logic for all of our current liabilities, right? So this is going to be the format for your cash flow from operating activities. So I would have this slide, I would make note of this. This is going to be your format when you're doing that first section on the statement of cash flows. After we get and so what we'll do then is we'll take our net income and then we'll add and subtract all the way down. And I think in your My Accounting Lab, they have you come to a subtotal for all the adjustments, adding and subtracting. Don't forget it's the net income plus or minus that to get to your net cash flow from operating activity. So that tells you whether cash increased or decreased as a result of your operating activities. Then you'll complete the next section, the cash flow from investing activities. And the cash flow from investing activities is any cash received or cash paid having to do with long-term assets. So if you sold a fixed asset, an investment, intangible assets, or received cash from a long-term notes receivable, that would be shown here, those sale proceeds. Okay. And then we'll subtract any cash you paid to buy any new long-term assets. So if you bought new equipment or a long-term investment, you're going to subtract that here. So the cash received minus the cash paid gives us our overall net cash flow from our investing activities. And so if the cash received is more than the cash paid, this is going to be a positive number. That's called net cash flow provided by investing activities. If the cash paid was more than the cash received, that's called net cash flow used for investing activities. So we get our overall change in cash due to our investing activities. We can then move on to our financing activities. So these are cash received and cash paid having to do with your long-term debt, or your stockholders' equity. So examples of cash received from finance activities. If we issue a note payable to borrow money, right? If we issue stock for cash, issue bonds for cash, these would be cash receipts. And then cash paid. So if we pay off a note payable, we pay off a bond, we pay dividends, or we buy treasury stock, these would be cash payments having to do with long-term debt and stockholders' equity. And so again, we take the total cash received, subtract the cash payments. If we received more cash than we paid, this would be net cash flow provided by financing activities. If the cash we received was less than the cash paid, then that would be the net cash flow used for financing activities, right? This is a negative number. So then after we have our three net cash flows, we can add them together. We'll get our net increase or decrease in cash. We take our cash at the beginning of the year, right? Whatever we ended last period with, we begin this period with. Okay. So the net increase in cash plus the cash at the beginning of the year should give our cash at the end of the year. And this needs to be the amount that we are showing on our balance sheet for cash. Then the very last thing we do is the schedule of non-cash investing and financing activities. So this schedule is going to show any investing and financing activities that don't involve a cash receipt or a cash payment. And so you can show this at the bottom of your statement of cash flows. So after we get the ending balance of cash, then you can have this statement, or it can be provided in the notes to the financial statements. So some examples of non-cash investing and financing transactions. So if we buy a long-term asset with a liability, so get a building with a mortgage, right? Buying a building, that's an investing activity. Borrowing money with a mortgage, that's a financing activity. Okay? But we can't show that under the cash flow section because cash wasn't involved. So that's why it's a non-cash investing and financing transaction. Let's say we issue stock for a non-cash asset. So we talked about this back in the stockholders' equity chapter. If we bought equipment and gave the vendor shares of stock, right? Issuing stock, that's a financing activity. Okay, but we can't show it as a financing activity because we didn't get cash for it, right? Buying equipment is an investing activity, but we didn't buy it with cash, so we can't show it under investing activities. We're going to show it here. So what we'll do on this schedule is we'll list a description of the transaction and show the amount. Okay. And so the reason for providing this schedule is that this is going to allow the reader of the financial statements to be able to see all of our non-cash investing and financing transactions between looking at the statement of cash flows in the investing activity section and the financing activity section and this schedule. They can see all of these transactions. And so that's the purpose for doing this.